Hi, everyone. I'm Noah Dreyfus from Dreyfus Capital Management.
And I'm Greg Drosdow from Drosdow Financial.
In this video, we're going to discuss what it means to invest in a stock. Greg, what are some common concerns you hear about investing in stocks?
Yeah, I would say I often hear from clients that investing in stocks or the markets is often like a form of gambling, and only true insiders of Wall Street know how to invest in the markets. Another common concern or misconception I hear from clients is that the only safe way to invest in stocks is by investing into indices or an index like the S&P 500. And I often feel like these concerns are just due to clients not truly understanding what stocks actually are. So, Noah, do you have any insights that you can share with all of us to clarify some of these concerns? What actually is a stock?
Yeah, absolutely. So I agree completely. The key to understanding what you're doing by investing is understanding what you're investing in. So when you purchase a stock, what you're doing is you're purchasing an ownership share in a company. So think about a company that your friend started. He's looking for a limited partner. He wants you to invest some money. You pull together some money and you invest in your friend's business. It's the same thing when you're investing in a stock. What you're purchasing is a fractional ownership share of a company, and in return, you're due a return of the profits of that company.
Got it. So, in the same way, when you buy an index fund, you are purchasing a fractional ownership share in a number of companies. And as an analogy, buying individual stocks would be like buying fruits at the grocery store versus buying a fruit basket, which would be similar to buying an index fund, right?
Yeah, that's correct. So whether you're buying individual stocks or investing in an index fund, it's important to understand what companies you're buying, how much you're buying of each. And since investing in stocks is buying ownership shares in companies, the best analogy is kind of the analogy we gave before of two friends kind of going into business together. Let's say Bob and Jim start a shoe company, ABC Shoe Company. Greg, what do you think the first consideration would be in starting their business together?
Well, ultimately, I think there would be three main considerations. One would be the cost of making shoes, right? The price that they're going to sell that shoe or shoes for, and the logistics. Number three, the logistics of getting the shoes to their customers.
Exactly. So first we have the cost of the shoe. Let's say Bob and Jim decide to go ahead and start the business, and they find out the cost of designing the shoe plus getting a manufacturer to produce the shoe and get it back to the States. All those logistics cost a total of $20. Well, if it costs $20 to make the shoe, they are going to have to price the shoe above $20 in order to make a profit margin. So Bob and Jim decide to sell the shoe for a sales price of $80.
Okay. So that sounds like a good profit margin, right? But when they go to start their business, Bob and Jim won't be able to manufacture one shoe at a time. When it comes to taking customers' orders, they're going to have to purchase a larger amount of inventory before they can go out and find customers. So they're going to have bigger upfront costs, right?
Yeah, and that's what's called their barrier of entry. So let's say it will cost them, let's say $500,000 to start their business, and Bob and Jim pool together $100,000 between the two of them. And they go to their local banker and say, hey, we're going to start this business. We need about $400,000 loan in order to cover our upfront costs of getting everything done, getting our inventory, so that we can satisfy our customer orders. So they take out a loan from their banker for $400,000, and the banker tells them, listen, I'm happy to lend you the $400,000, but I'm going to need an 8% interest rate in return for the risk of the loan. So they take the $400,000 at an 8% interest rate, and that gives them an initial debt cost of $32,000 per year, or their interest costs on that loan.
So if they have 32,000 in debt costs, that means that they'll have to surpass that in sales, obviously, just to cover their debt, right?
Yes, that's correct. So let's say at the end of year one, Bob and Jim knock it out of the park, and they go ahead and sell 10,000 units of shoes or 10,000 pairs of shoes.
So if Bob and Jim sell 10,000 pairs of shoes and profit $60 per pair, that works to be $600,000 profit. Yeah.
Yes, but not exactly. So that would equate to a roughly $600,000 gross profit margin. Bob and Jim are going to have to look at a few different things before they can actually figure out what their profits are from the business. Let's say in this circumstances, they have $32,000 in interest costs per year. They have to pay that back to the bank. And in addition, because they are profitable, they want to go ahead and pay a portion of that principal back of what they borrowed. So let's say in this instance, they decide on a even amount of $60,000 total going back to the bank, $28,000 in principal payments and $32,000 in interest costs. So they're going to subtract $60,000 from their total debt, from their gross profit margin in total debt cost. They also, Bob and Jim decide to recoup the initial $100,000 they put into the business, refill their savings account, and also give themselves salaries as employees of ABC Shoe Company of $75,000 each. So $75,000 to Bob, $75,000 to Jim, plus $100,000 to recoup their initial investment. And they're going to take total compensation of $250,000.
So let's say the total expenses that Bob and Jim have to account for this. So you mentioned total of 310,000. If the gross profit margin is 600,000, the expenses are 310,000. Net profit margin is the remainder, which is 290,000, right?
Exactly. So now let's say when Bob and Jim set up their corporation, they started with a total share count of 1 million shares. And they knocked it out of the park year one. A larger shoe company that's looking to expand their market into the market that Bob and Jim are catering to with their shoe company decides ABC Shoe Company would be a great investment for them. So they approach Bob and Jim and say, hey, we want to buy, let's say 10% of ABC shoes. Well, if Bob and Jim are going to consider that investment, what they're going to have to do is they're going to have to figure out what each one of the 1 million shares that they issued the corporation with is worth.
Okay. So how would Bob and Jim figure out the value of each share?
So let's start with some simple math. So we have a $290,000 net profit margin, and we have 1 million in total shares. Let's take $290,000 and divide it by 1 million. What we're going to get is the earnings per share amount of 29 cents per share.
Okay. But Bob and Jim wouldn't sell shares for just the earnings per share value, right? That would give the buyer ownership of the future profits of ABC Shoe Company for the price of this year's profits alone, without giving value to all the hard work Bob and Jim did to design and actually sell their shoes. Right?
Yeah. So imagine I came in as an investor, and this year's profits was 29 cents per share, and I offered you 29 cents per share for 10% of the company. You would kind of laugh at me because I'm basically free rolling on all future years of profit. So that would not be equitable. So Bob and Jim do some research and realize that they are selling shoes in what's called a segment of the market called discretionary goods. And the typical discretionary goods companies, they do a little Google search. They find out that the average stock or company that trades in discretionary goods typically gets a multiple of earnings per share of 22 to 1.
Okay.
So, yeah.
Got it. So essentially, if an investor wanted to purchase, let's say 100,000 shares or 10% of the company, a fair price to pay would be $638,000 or 100,000 shares times $6.38. Is this how investors should look at stocks when they want to figure out if they're paying fair price?
Yeah, let's rewind the math on that. So if we take 29 cents and we're going to go ahead and times that by 22, we get to a share price of $6.38. And so we're going to go ahead and fair value of ABC stock at $6.38. So with that, let's take another example. We have ABC stock, which is in the discretionary goods space, and we have $1.25 in earnings. And we know the discretionary price to earnings multiple on average is 22. What we're going to do is we're going to take $1.25, multiply that by 22, and we're going to get fair value of ABC stock at $27.50.
Got it. So how does this work with the stock market, which is a number of stocks?
Yeah, absolutely. Great question. So at the end of every year, the S&P 500, whatever index you're looking at, is going to take the total amount of shares in that index, and then it's going to take the total amount of earnings of each company within that index, and it's going to report an earnings per share amount for that group of stocks or that index. In the case of the S&P 500, the total market. So in the example of the S&P 500, in 2021, the S&P 500 reported $190.39 as the total earnings amount for 2021. If you do quick Google search, you find that the average price to earnings multiple of the S&P 500 over time, over the history of recorded stock history, is about 18 to 1. So if we take $190.39 and we multiply that by 18, we get to a fair value for the S&P 500 in the beginning of 2022 of $3,427. So obviously prices can fluctuate dramatically up and down from there. And if we go ahead and look at the S&P 500 at any point in time in 2021, it varied quite a bit from that figure of $3,427. So let's take a look. And so in 2021, we varied all the way from 3,700 all the way to 4,700, right? So we never really came close to that 3,427 fair value mark. At the same time, the market in 2022 crashed, right? And so the fair value estimate that we gave for earnings of the S&P 500 was a guideline or a baseline assumption that we can look for fair value. We just have to keep in mind that the market at any point in time can vary widely from that. And we need to do a little bit of research to understand why the market is varying from that fair value, give an educated hypothesis, and then proceed accordingly as an investor.
Got it. Wow. That was super informative, Noah. Thank you. So again, in summary, to all of you watching, we hope this video provided you with some value around understanding what a stock is and how to have a basic idea whether a stock is overvalued or undervalued. Stay tuned for more educational content from us coming soon.
Awesome. Thank you, Greg. And please don't forget, if you like the content in this video, subscribe, like, and share. We'll see you in the next video. If you have any questions about your investment journey or struggling with the questions of, I understand or I don't understand the fair value of what I'm investing in, and you want a professional to take a look, we at Dreyfus Capital would be happy to take a look for you. Thank you very much and have a great day.